Divi's is the stock in focus. Just came out with results, and on the looks of it, the EBITDA number has come in quite lower to what the street was actually estimating. 500 crore versus 565 was the estimate. Even on the margin front, 28% versus 20.5 poll. So there seemed to be some amount of mismatch between actual and the estimated as far as the street estimate was concerned. The street was expecting almost 4% kind of a API division growth on a sequential basis. It appears that the numbers actually have been slightly on the lower side. But let's take the discussion forward with Trideep Bhattacharya, who is joining us from Edelweiss Mutual Fund. Trideep, afternoon. Thank you so much for your time. First of all, I'd like to understand from you your take on, the pharma space. There's a sense emerging that probably the worst for pharma may be coming to an end on pricing pressure, inventory issues, raw material, all of that, which lasted 4-5 years. Would you subscribe to that view? And have you started adding some names in your funds?
Good afternoon, Ajay. Always a pleasure to be on your show. I would say that, yes, over the last 3 months, or probably slightly longer, we have increased our weightages, our weightage in pharma. Though, unlike IT, which is a sectoral view, in pharma we have taken a more nuanced, bottom-up, stock-specific view, which is, we have increased our exposure to stocks which are more exposed to the US generics, because that is where pricing pressure is abating. We have to see how long it will last, but for now that seems to be the case for the next few quarters. And secondly, on the domestic oriented companies, the commodity tailwind, or shall we say a lack of headwind, is kind of having a positive impact on the numbers. Though I would say that the stock has had the sector has had a good run, and we might see some profit booking in the very short term. But that aside, overall, we used to be underweight. We are now mostly neutral, is what I would say. But in this sector, we rely more on stock picking to make the difference rather than sectoral weights.
Trideep, I also want to understand from you, the capital goods space. You have a lot of names across your funds as far as capital goods space is concerned, and they have had a very good run in the last 12 to 24 months. But view is that now is the valuation becoming a bit of an issue? Is best of the times already getting priced in that one? Is that a bit of a challenge now?
I think from a near-term perspective, some bit of profit booking on account of stellar performance is can't be ruled out. And also, I think overall these companies, as the base grows, so when they were growing 12 months ago, they were on a depressed base. 12 months later, today the base is probably slightly higher than, or not as depressed as it were. But still, if you look at some of the leading EPC companies, they are still, in the last result season, they beat the consensus estimates, I believe, by about close to 20-odd%. Now, I don't recollect in my 20-25 years of markets experience in India when I saw last time such a big beat coming through. So likewise, I think the earnings surprise is there or thereabouts. The quantum of surprise is probably a little lower than what it used to be on the back of higher base, but the momentum still continues. So that's how I would phrase it. So maybe time to take a more selective view, but in terms of the theme, in terms of the capex cycle and all of that, that's probably still intact and probably one of the strongest themes at the moment in the market.
What's your standing as far as mid-cap IT is concerned? Because it appears that on incremental bad news, the IT stocks are not falling anymore. Do you think in the next 6 to 8 months, when the order book visibility and demand visibility comes back, this pocket can deliver good returns, or would you stay away?
No. So returns is an outcome. I would say that next 3 to 6 months is a good time to look at in IT services from a virtue of maybe selective stock selection to get the stock selection right from the 12 to 18 month perspective. Because I think from where we are with regards to demand, with rates at peak and US banks, etc., are where they are, there's probably a lot of bad news being priced in at the moment. But from a return perspective, are things going to improve in the next 1 or 2 quarters? My guess would be no. I think it will probably take the next year for that improvement to come through. But the valuations over the next 1 or 2 quarters would be good to add. So on net balance, we used to be underweight IT meaningfully by about 300 basis points, maybe end of last year. We moved that to neutral at the moment, and in weakness, we would look to go overweight. This is a more sectoral call than stock specific, as opposed to what I talked about on pharma. But we would look to move overweight in weakness in this area.
So have Equitas Small Finance Bank in your small cap fund. You have Shriram Finance in your mid cap fund. I want to understand your take on the NBFC and the small finance side. The Q4 numbers showed very good numbers on. Do you think that the risk reward and the earnings growth potential in some of the small finance names, some of the NBFC names actually are higher than the banking?
Again, good spot. At the outset, I would say lending financials from the next 1 to 2 years are in a good spot. Now, within lending financials, given that interest rates have peaked or closer to peak, banks' margins, NIMs, are broadly at its highest level and gradually coming down. And given that the liquidity conditions are likely to ease, NBFCs are slightly better positioned than that of banks within the context of the lending financials that way. So incrementally, yes, incremental allocation from our side has gone more towards NBFCs as opposed to that of banks. With regards to small finance banks, I think my view has always been on a structural basis that this is a area where we would like to take bet, but only on very high quality companies, because the segment is quite risk prone. Anything kind of goes awry in the macro, and this segment could see a meaningful kind of negative downdraft cyclically though, and one has to guard against that. So cautiously optimistic on SFB, probably more positive on NBFCs, and generally structurally from a 1 to 2 year perspective, positive on lending financials is how I would summarize. Ajay.
Pradeep, before I let you go, I want to understand one issue which is in the last few days come up on the table, and that is whether it's a pivot or a pause, especially with the kind of numbers we are seeing on inflation front all over the world, not only in India. The agri-commodity side and bit of energy has led to a spike in them, which is making many believe that the pause which central bankers, including ours, got into will be temporary in nature and more rate hikes are back on the table. If that is the case, could it become a near-term headwind for the market globally?
Very interesting question, and I would put a thought and see how that goes. And here is my thinking. In my opinion, on net balance from the last 6-9 months, I've been saying that inflation across the globe and India is likely to be stickier than what most people think. And apart from the commodity price movements, which will do their own stuff in near term, my sense is the reason behind a slightly structural higher inflation is every country is kind of going for a Make in India version within themselves. Now, if every country were to manufacture their own goods rather than kind of getting them manufactured at the lowest cost location and selling at the highest price location, generally from a 2 to 3 year perspective or from a medium term perspective, structurally inflation is going to be higher than what we have been used to over the last 5-10 years, where things used to get manufactured in the lowest cost destination overall. So that's one of my resident long-term view with regards to how I see things evolve. Now, in generally inflationary circumstances, two asset classes do particularly well. Equities is one, which is kind of as an inflation hedge, the best known inflation hedge, so to speak, and gold. When kind of overall things go pear-shaped, gold could be a good risk option. So again, from an asset allocation perspective, a slightly longer term answer to your question that overall, yes, inflation is likely to be stickier, and hence rates, while they might have peaked, coming down might take some time, and hence the asset allocation could needs to be thought about in that context.
Right. Pradeep, how are you playing the power value chain? Be it, the generation companies, both on the legacy side or in the renewables, the power, the wind, etc. And, then there are transmission towers, then there are generators and motor companies down. How are you really playing this entire value chain?
So, a leading question, and I would kind of leave the framework with you in terms of the way we go about this. So, in all of the segments of the supply chain that you talked about, some parts are very prone to regulatory risk. Some parts are very prone to kind of overexposure to the government and hence kind of could lead to receivables issues, is that our focus has always been in such circumstances to focus on nuts and the companies that supply nuts and bolts to these industries, because that is where we have the best semblance of pricing power, a best semblance of working capital needs, and or in other words, what best semblance of return ratios, and are usually the most profitable ways to places to be. So we have a couple of names in our portfolio, in broader portfolios, and that's the framework we use to sort of to look for names in this area.
Right. All right, Sudeep, we'll let you go on that one. Thanks so much for sharing your thoughts on various parts of the market.